Hello, I'm Neil Stanley, and this is an episode of To the Point where we're going to talk about negative real interest rates. Now, I didn't say negative interest rates, I said negative real interest rates. Decades ago, economists became familiar with this term, negative real interest rates. Real interest rates are calculated by subtracting inflation from the nominal interest rates. Today, we're forced to revisit this issue. Interest rates have fallen below the inflation rate, or you could say inflation has now overtaken interest rates. The consumer price index for all urban customers, excluding food and energy, has now risen to a level that is above the mortgage rate. The 30-year fixed rate mortgage is now below inflation, and that has not happened for a long time. In the last 50 years, since the 1970s, when the Freddie Mac began reporting the average 30-year mortgage rate, we've only experienced inflation rates above mortgage rates 3% of the time. The past two periods of time when this occurred were back here in the 70s, from August 74 through July 75, and then 2 months in the 80s, June and July. And since then, inflation has been below the mortgage rate until May of this year. Now, I presented the majority of this chart of major economic indices in a previous To the Point episode. However, due to the impact of inflation, we have now added it to the graphic. You can see where inflation is now above the unemployment level for the first time on this chart dating back to 2005. As financial institutions, you own a portion of the fixed income market. We want to clearly understand the magnitude of this glut of fixed income securities that we've experienced since the pandemic. This must be considered as we think about portfolio management. Ask this simple question: since when did a glut of something make the price of it rise to an all-time high? Looking here at the fixed income market, you can see that in the first 5 years of the previous decade, we saw about a $1 trillion annual growth rate in fixed income securities. And then from 15 to 19, we went from 38 trillion to 44 trillion. That's an average increase of about 1.5 trillion. But in the year 2020, we grew this market $6 trillion. You can find this chart yourself, this data yourself, by using the link that I identify here. The magnitude of monetary policy decisions have been intensified as the debt to GDP has risen. The relationship between government debt and GDP is a weighty subject, with many people expressing their thinking that interest rates cannot go up because we simply can't afford it. But keep in mind, this isn't like a typical purchase decision where every day we get to decide what we can afford and how much we're going to buy based upon the value to us and the price. Keep in mind that we have already been obligated to this debt. So in that case, where's the borrower's negotiating power in this situation? The magnitude of the monetary policy decisions have been intensified. And now, as we look at the disparity of financial institutions' weight on fixed income assets, we look here at the UBPR, where we show total loans and securities over 15 years. The median is about 8% of the balance sheet is in those fixed income assets. But if you're over here in these sections, where you have more than peer, you really need to be thinking about what this could mean if this environment where we have so much fixed income assets at a price point that is towards the highest in market history. We wanted to make sure that this was on your line of sight here. As our valued clients, we want to make sure that you are fully addressing all of these issues in thinking about how to manage your portfolios. To give you a robust access, we have posted the key economic resources for bankers on our website. If you go to thecorepoint.com, hover over resources and click on analytics, you can select key economic resources for bankers. And that's going to bring up a slide like this that you can then click on the various categories. And the things that we've shown you are listed here in this section of the website. I just want to thank you for the opportunity to again present to you this episode. Please set up an appointment with me anytime you want to meet to talk about this or any other important topics. We've greatly appreciated the opportunity to meet with so many banks leaders over the last several months, and this is just an opportunity for me to extend an offer to you to continue that process. So as we wrap up here in this Thanksgiving week, I want to wish each and every one of you a great holiday, a great celebration of Thanksgiving, and encourage you to attend the next episode of To the Point.